the whole course is all about valuing the equity, putting your money in equity, managing your equity portfolio, maximizing your returns. Okay, so we gradually started from broad markets to instruments and now straight away into your equity valuation. Okay. When I was asking one of you or some of you in the class, do you have the equity or something like that? I think 3 or 4 of you told me that yes, you hold some equities. And when I asked you what was the criteria for that, you mentioned that you had a random advisors taken or for some other reasons, which is a celebrity stock kind of thing. Tesla, Google, they all are known. But from now onwards, if you're picking up a stock, that shouldn't be the criteria. We'll be fundamentally strong to pick up a stock. So how it will be done, we'll be doing that today. Let's go ahead.
Yeah,
sorry, I didn't see you.
Kind of off topic. Did you buy any Klarna? The company Klarna?
I didn't follow that. You have it or you want to buy?
I was asking if you bought.
No. I didn't start. I am an active investor for the past many years, but I didn't start my portfolio here. I was just following the real estate. I started with real estate. Maybe from Jan next year onwards, I'll be into stocks. Okay. What I did is we have within equity valuation, I divided the whole topic into 4 pieces so that it will be easy for us to combine together as segments. So the first part is all about equity. We'll start a kind of awareness with equity. So I try to make you establish a relationship between equity analysis and macro analysis, which includes economic and industry. And we also try to differentiate these two. That's number one. And that way you are going to differentiate company or the firm analysis and equity analysis. Then assess profitability of investments using yields. I think this you have already done or have gone through, but we'll be revisiting them. We'll be seeing the calculation of return on equity kind of things. So what you have in this segment is, we'll see what is equity analysis, company versus stock, why equity valuation, equity returns, and what kind of valuation we'll be doing. Okay. Have you heard about this? Fundamental analysis, technical analysis. Sort of. Okay. So I think when we look at picking a stock, I think you might have seen analysts on CNBC or some other channels showing the charts and this is going to be a maximum, the price will shoot up, and this is the least bottom level for this stock. So if you're looking at that, we are trying to look for a timing to pick a stock. We call it as technical analysis. Okay. But before that, we have to do fundamental analysis. Fundamental analysis talks about which industry and in that industry, which stock to pick. That is fundamental analysis. Technical analysis tells you when to pick the stock that you wanted to pick. The timing is technical. Fundamental is what you want. Technical is when you're supposed to take it, timing. So that's how these two go. So the whole fundamental analysis is dealt in our course, but technical analysis we don't have. We'll just introduce and go to the next topics. When you look at fundamental analysis, I think I was telling you in the earlier class also, you have top-down approach and bottom-up approach. Top-down approach is doing economic analysis, a broader picture, knowing about economic indicators, inflation, interest rates, indices, foreign currency, reserves, exchange rates, and so on. And you try to assess the economic condition and try to take a call. Which economy is good? Importantly, the global investors, they pick up emerging economies, and they try to leave overheated economies, markets, and they try to shift to some other profitable markets. So they look at top-down approach. Okay. So most of the hedge funds, importantly, they are very swift in moving from one market to another market, though they're not fundamentally looking at some asset classes. They're rapid in moving from one market to other market. Apart from them, we have institutional investors. I think foreign institutional investors, they're quite active in doing top-down approach analysis. I think in industry analysis, while talking about industries, we also talked about economy, where we have seen a sector rotation. Remember when sector shifting strategies were adopted, when the economy is expanding from the recession, I think there will be a shift in the investments from one sector to another set of sectors. Okay. Then I think when you look at some investors, Soros is a big name for top-down analysis. He always preaches that. He looks at global macro scenario, not just US. Then Ray Dalio, he says all-weather strategy based on economic indicators like inflation, growth, and recession. So these are some of the insights into why they look at a top-down approach. Okay. Then we have the other approach, bottom-up approach. Here, this is analysis is the same, but where you are starting, that is important here. So what you do here is you start from your company. You pick up the company first, your company, what company you wanted to invest in. Then you do start analyzing that company. Then you do the industry analysis. Then you look at the economic environment, whether it is fitting your investment decision or not. This you call it as a bottom-up approach. Most of the investors, I think, who are looking at value investments, they do this bottom-up approach. So I think Warren Buffett is a big name on this. I think Charles Munger, have you heard about this name? You know him, right? He's a vice chairman of Berkshire Hathaway. Warren Buffett makes the decision process. I think he's no more in their combination, but he's the guy who used to do a lot of research. If he picks up a stock, he used to work a lot on that industry, everything related to that industry. And he was so much research oriented, his doctor suggested him, if you go on doing like this, you will lose your eyesight and you may lose your eyes. And he said, no problem, I'll learn Braille. So such a passionate researcher he is. So what I'm trying to tell you here is, if you pick up one sector or one stock, it's very important to do the homework, everything related to that. So if you're a value investor, it's more. Okay. So insider information, when you have some managerial level executive in a company known, or some of the board members of the board of directors is known to you, he throws a piece of information in your mind. Then you try to analyze. You pick up, you try to analyze the whole company's financials, operational, like you have done, I think submitted yesterday. You try to do it. So insider information is also one way of looking at bottom up approach. Sorry. Technical analysis. I think I just started the session with that. You try to know the timing of the market for your stock which you wanted to buy. Not only that, speculators, if you remember, we have seen the speculators taking a long position and short position. You remember that? Even buying on margin, selling on margin to make short-term profits. It's too risky. So value investors looking for timing to join the investments or do the investments, or speculators or traders to make money in the short term, within a day or in few days or a week or maximum 1 month. They completely rely on technical charts. So when you look at the technical analysis, what's the momentum and what are the moving averages? I think if you can see that, you'll understand that better. Let me go through that. Which one? I think I like this website, FinViz. Time permits, after the session you go through this. Which stock would you like to see? Sorry?
Who's this stock? UPS, Open Door.
Open Door? You have a stock pick from the class, please note it down. What's the code?
Open.
Okay. Open Door, you like technology. You said that, I remember. Yeah, this is a kind of a technical chart for Open Door technologies. This is daily, we may have weekly, intraday, we may not get because market is closed. Okay. So this is, these are how to, it's not showing. Okay, quickly, these are the line charts. And this is interesting. Do you know what is this? The red and green things? Any guess? They're known as Japanese candlesticks. So what do you see from them? Let me pick, I think this is much bigger so that it will be visible to you. You can see this. So this is the high. The top part is the high for this stock. This is, I did a click, let us check daily. Okay. So maybe this is 11th of, market is closed. So this should be 11th of September. So this is the highest and this is the lowest. Okay. And why it is green? Because the market opened here at 7.57 and closed at 10.47. Okay. Means the close is greater than the open. Market closed positively. That's the reason it is showing green. It's a green candlestick. If it is red, the close is less than open. It's a bad sign for the market. Green is good sign for the market. Okay. So you also have some trends. You may also see some moving averages. I want to look at 1 week moving average and 1 month moving average and how they are moving. Okay. So for example, weekly our moving average is coming down, but monthly moving average is going up. We have some pattern. We are not going details of that. I'm just introducing. If at all you see a screen like this, you should not be lost. Okay. So Anything interesting for you from the screen?
Yeah, it went up, their volume was like 300 something million, and it went up by $4.
Uh,
And
okay.
they added a new CEO.
Okay.
In the screen, it owes green.
Yeah, I wish we had a class in the trading hour so that we can see the live screen. I can open my account and show that to you. Okay. So this is how the technical charts will look like. So you have momentum, how rapid they are moving. They also look at the volume, not just the price. Sometimes volume is so huge, but price is not moving. And the other way, volume is less, but the price is so volatile. So that indicates something. So that way you have the point and figure charts. So the breadth talks about what are short positions, long positions, what's the volume of the trade and so on. Just now I was talking about Japanese candlestick. There is one measure called a relative strength index based on the momentum and the trades. Similarly, we may discuss these things in behavioral finance based on the pattern, trends and corrections, sentiment indicators. We have something called trend, confidence index, short interest put call ratio. This is how a technical analysis will look like. Okay, coming back to our fundamental analysis. So before you get ready to do some fundamental analysis of your own company, so I want all my students in the class to simulate yourself to pick up a stock. So I think you already gone through, submitted the industry expert report. So by this time, you got a fair idea on which industry is what. Some idea. You're not experts. I named it as expert. You will become experts later. Okay. So I want you all to have choose some industries. One, at least minimum one. You can choose two or three also. And I'm using the word industry means I gave you for your assignment, I gave you sectors, which is very broad. Okay. Within that, you have many. Okay. To show you that quickly, let me go back to this FinViz again. Mm. This is very interesting to me. I like this. So you have S&P 500 stocks here distributed with all the industries. So it was interesting. Google falls in communication services. Okay. So you find everything, anything here. You have Microsoft here. So the bigger squares means it's the market leader. Tesla is the market leader in consumer cyclical, consumer defense, Walmart. Of course, Google here, healthcare. It's very competitive. So who is bigger here? Lilly. Okay. I thought Johnson and Johnson. Okay. Okay. And insurance sector, we have Berkshire Hathaway. Semiconductors, we have NVIDIA and Broadcom. So this is very interesting. If you want to pick up any industry, I think you can use this or any other source of your choice. It's all up to you. I'm not restricting you, use this and don't use that. It's all up to you. Okay. Coming back, talking about equity shares. So we have been talking about asset classes, money market instruments, capital market instruments, debt instruments, equity instruments, and so on. So we have equity shares to discuss completely today. So when you are talking about equity shares, you have preferential equity and common shares. So whenever I use the word equity, we're talking about common shares. Preferential equity has a different meaning. It does not mean that all the corporations will have preferential equity. Don't get confused. So when I'm saying equity, it is common shares, nothing else. So when you look at, I think when I was young, one motive for me to buy a share is to become a owner of a company. I'm not that serious about returns. Okay. I always wanted to buy shares to see myself as the owner of that company. Okay. So shares give you ownership. So more number of shares you have for a company, you are more powerful. Usually founders and institutional investors, they have more shares. So more is the ownership, more is the control. Because when you have more shares on your name, you can control through voting and electing or selecting directors. And directors further take care of hiring managers, CEOs, CFOs, CIOs, and so on, operations managers, and so on. And this is something interesting. Management. There is something called agency problem. Agency problem is kind of conflict between the owners and managers. And board of directors, their role is to ensure that managers work for the interest of the shareholders and maximize the wealth of the company so that wealth of the shareholders is maximized. That's the idea. Now, uh, uh, I made this so that you can differentiate a company and stock or equity. Okay. When you talk about a company individually, a corporation, and when it is aggregated, you call it as industry. That's the assignment you did. In the stocks, when you talk about a stock, it's a stock of a company. But when you talk about more stocks or all the stocks, you are referring to stock market. New York Stock Exchange or NASDAQ, wherever it is listed and traded. So accordingly, you have growth companies, growth stocks, cyclical companies, cyclical stocks, defensive companies, defensive stocks, speculative companies, and speculative stocks. Did we see the defensive anytime in the previous sessions? Defensive, cyclical, growth. Did we see this anytime in the previous sessions? We have seen business cycles. Business cycles, there are some companies which are insulated from business cycles. That you call them as defensive industries, defensive stocks. Okay. Now, one interesting thing here is, or rather, a question is a growth company a growth stock? Is a defensive company a defensive stock? So my question here is, when you say defensive company, just now I clarified that it is related to business cycles. It is insulated from business cycles. So we are calling it as defensive stock. Similarly, I'm sorry, defensive company. Similarly, defensive stock. So we are talking about the relationship between the stock and the market. Here, the relationship between stock and the market. Here, the relationship is between the company and the industry or economy. That's how we look at. Please understand that difference. Now, let us look at growth company and growth stock. I think if you remember, we have seen industry life cycle. Remember, this is we have seen 4 stages. What are they? The first stage is inception, or the company getting innovated, and it is in the sprouting stage and started picking up. And this is the expansion stage. This is the saturation. This is the decline stage. It's not necessary every industry will decline. There are alternative plans so that alternatively it will grow. Okay. So my question to you is a growth company and growth stock, both are same? If you have a stock in a growth industry, it means that your stock is also growing. What do you say?
Yeah.
Why?
No stock can be any other stock that has potential to grow at a different industry.
Okay. Good. So that's what I'm trying to showcase here on the screen for you all. So I was clearly mentioning that growth companies, they generally not been growth stocks. That has been the history. And growth stocks are not necessarily in growth companies. Why? Because when you say growth stock, it is about rate of return on that stock you're holding. And you compare that to a similar stock with a similar risk profile. Then the other thing is risk adjusted rate of return. It occurs because of market undervaluation compared to other stocks. So the risk is more important when it comes to stock. Risk in terms of return, volatility of return. Similarly, speculative company versus speculative stocks. So speculative companies, they run with minimum investments and they look for maximum returns. I don't clearly define them as speculative, but if you look at technology companies, investment is low, but the probable expected returns are too high. Okay, so anything may happen. So that's what you may call it as a speculative company. And speculative stock, if you look at index stocks and non-index stocks, index stocks, liquidity is very high. They're active. If you pick up S&P 500 stock, you take Google, you take Tesla, you take any other company in S&P 500, you don't bother about liquidity. They're actively traded. But if you take a small penny stock, which is not part of S&P 500, I think activity is very little, and people don't try to trade on that. They don't try to speculate on that. So that's how you can differentiate speculative stocks and speculative industries or companies. Then defensive company, I think I just started with this only. Defensive companies, when you talk about company, they're insulated with business cycles, whatever the stage is, like we discussed about daily necessities, uh, like FMCG, fast moving consumer goods. If any company is engaged in that, I think it has to run. Even in the pandemic situation, that has to happen. Same is the case with the defensive stocks. Here we are talking about impact of markets. Maybe we'll talk about beta later in the CAPM and other classes. So if you have a stock with a very low beta, its impact on the stock price is low, which means that it is not influenced by the market. It has its own valuation. Traders, investors buy and sell the stock because of the stock, not because of the market. Okay, so that's how you can differentiate a defensive company and a defensive stock. And cyclical company versus cyclical stocks goes with the business cycle company. It's a cyclical company, and a stock which is moving along with the, I think the beta is almost one, neither greater than one or less than one. It's just going with the market. It's taking the market direction. That is cyclical company and cyclical stock. So why we are supposed to differentiate all these four is, when you pick up a stock, it's very important because you'll be making up your mind. Because are you risk averse or you are a risk taker? You have to question that first and write the answer. See, I gave you four. If you are a risk taker, what kind of stocks would you take? Yeah.
I mean, you could say like stock.
Speculative stock. You're a risk taker, right? Speculative stock. I think even you can also take growth stocks, and you can also take cyclical stocks. If you're risk averse, for sure you'll be looking at defensive stock. Okay. And while you're analyzing industry and company, again you have to apply the same method while picking up the stock. Now, why we are talking about stocks and how it looks like, what category it is, and so on. So why equity valuation is required? Why people do equity valuation? It's like that because yes, as a instructor in the class today, I can tell you to do the valuation. We'll be doing that in the class today. But out of the class, why will you do equity valuation? By yourself, by your interest. Yeah.
Reduce risk.
Reduce risk, okay. I think we discussed that. Based on the risk, I'm sorry, based on the company and stock, cyclical, defensive, it talks about returns, risk, and so on. But I'm asking about equity valuation as a process because it's not that easy, and it consumes a lot of time also, time, money, and efforts. Still, people are doing this. What for? What is their objective? Yeah. Perfect. So it's you picked up your own industry, you liked it, and you picked up your own company, which is listed in New York Stock Exchange. So you straight away go and buy it because you like it? No, you have to do the valuation. Okay. So if you compare the market price of your stock with the valuation by yourself done, then you have a comparison. Okay. I think that's how you'll be doing. So you're in a search to find a stock. What kind of a stock is that? Undervalued stock. So what do you mean by undervaluation? Undervalued stock, uh, Google or Apple you take is trading at 230 today, closed at 230. You picked up Apple, you have seen broad prospects in the coming 10 years. It will grow exponentially. That is your analysis. It is trading at 230. Then accordingly, you will do some valuation and arrive at a number. It is worth of 200 to 210. One student says that. The other student says that, no, it's worth of 240 to 260. We have two values here. That we compare that to market price. Then we make a decision. Okay. If your value is greater than market price, how much is Apple now? 230. Your value is 210, assume you arrived at a value of 210, $210 per share. So in that case, in the market, it is overvalued, properly valued, or undervalued. What do you think? It is trading at 230, but your analysis, your valuation says that it is worth of $210 per share. So what do you say? Is that overvalued, undervalued, or properly valued? It's overvalued because it is worth of 210, but it is trading at 230. It is overvalued. Similarly, if I look for another stock, how much is Tesla? 366. And your analysis, he did the analysis and he says that it is worth of $380 per share. It is undervalued. It is worth of buying that stock. So we do equity valuation through analyzing all the components related to equity, industry, firm, economy to find out the undervalued stocks. We don't care about overvalued stocks, right? That is the idea. So how do we do that? How to find true value of a stock, or it's also known as intrinsic value. Let us not use real value. Real value is related to inflation. When you're adjusting something to inflation, you use the word real value. So in stock valuation, the true value or intrinsic value or fundamental value. So I think I'm using a top-down approach. If you want to know the true value of a stock, start with your economic and industry analysis first. If economy is so bad and industry is not encouraging, business is not good, you will not think about investments, right? Not right now, at least. Maybe later. You'll postpone your investments. That's how you have to look at economic and industry analysis. Then select an industry of your choice once the industry is done. By the way, when I gave the assignment, you're asking me, why can't you let us choose your own industry, if you remember? But I told you that let us start this way. In the coming session, you will be doing that. So from now onwards, you start picking your own industries and try to get some numbers accumulated. That will be very useful. By this time, did anyone of you have any industry in your mind? One or two or three? Anyone? Can you share which industry was that? If you had that in your mind. Hospital and real estate? You really real estate, you always say that. Good. Okay. Any other industry? You got two industries. Aerospace, I remember. I think SpaceX is not there. It's there, but it's not listed. I wish you are all are aware. It is not publicly traded. Maybe someday it will come. Okay, anyone else? Have you chosen your industry? One or two? Yeah? Here's something? Oh, sorry. Okay. So please go through some industries and you may have some connection with the industry's flavor so that you're interested in talking about that and putting your money there. Then evaluate performance of stocks in your industry once the industry is done, which is the best. Okay. For example, just now we have seen in FinViz the blocks, green and red blocks showing an industry. Pick up one company. It's up to you if you want to pick a market leader. Maybe it's a kind of speculative or growth stock, and it is a company which has a small share. Maybe it's a penny stock. It's all up to you. No, make a buy decision and keep on evaluating your portfolio once you have investment done. And quickly on who does Equity valuation. My earlier question was why equity valuation? Then it's not that everyone can do the equity valuation. That's how we all are together here in this class. So individually, shareholders would be knowing about their dividends to be received and their capital gains in the coming quarter or a year. They're very much excited to know about the value of their share. They know the value right now, but in future, what will be their value? They want to know, so that they want to sell their come out of that company shares or buy more or do nothing. Then investors, I think we just discussed. I have also plans to invest. I started my own analysis here. My analysis is stronger, but I have some association with someone else, but I want to do it for myself. If we are doing it in a good way, take time, no problem. But the analysis should be good. Academicians like you and me, where we'll be working on the analysis and the research part of the investments, and there could be individual advisors who are certified and analysts in equity doing research and giving advisors and portfolio managers. I think individuals can't do portfolio managers. Maybe in some countries it may be possible. I'm not sure. At the institution level, all the investment companies you have, all these institutions, and in other dimension, the management itself wants to decide the equity value of the firm, because it may wants to issue new shares to the public, FPO, rights offering. It may wants to declare dividend. There are many decisions to be taken. It wants to go for new capital. They are decided whether debt or equity. So equity valuation is important. Then suppliers, when they have a long-term relationship with a company, they look at their valuations, and regulators also look at the equity valuation. Once you are clear with this, you're getting slowly ready to do the equity valuation. So for that, you need to have these four broad parameters or tools needed. Face value, it is one unit value of any share. It could be $1, $10, or $100. Okay, that you call face value. Market value is the price of the equity getting trade value of the equity which is traded in the market price of the share. Then ratio analysis. Did we see this? Ratio analysis. Yeah, in the last class. We have seen financial statement analysis and ratio analysis. We have seen profitability analysis, turnover ratios, liquidity ratios, leverage ratios. We also have seen DuPont analysis, how return of equity can be calculated away from the traditional model. And when you talk about equity valuation, I think dividend discount model is very popular. Okay, so dividend has a major implication. There are many theories around it. When a company's the Miller and Modigliani's paper, they said that when a company declares dividend, it doesn't make any impact on the market price of the share. They call it as dividend irrelevance model. I was working on presented one paper on dividend. That is the paper of Bhattacharya. He says that no, dividends are relevant. When a company gives dividend, it gives positive signals to the market. Means it is cash rich. It has a lot of projects in future. And so when you look at dividends, you have dividend per share, payout ratio or DP ratio, retention ratio, usually represented with small letter B in most of the books or texts. Then dividend payment history. There are many companies which are known for dividend payments. I was talking about Johnson and Johnson. It is one of the companies which is paying dividends for the past 50 years, more than 50 years. It is paying. There is a a group called Dividend Kings, where they are grouped together as a reputed companies to pay dividend for more than 50 years. Yeah, I think I have something to show on that. Then dividend payment consistency means at what rate they are paying. Is that the same dividend rate or constant with constant growth rate? So there is something called X dividend and cum dividend. Have you heard about this anytime? Can you quickly tell me, is there any company paying dividend today or yesterday or this month? Do a quick search. Any company in this month paying dividend or declared dividend? I think Johnson & Johnson did that, if I'm not wrong. I'm talking too much about Johnson & Johnson today. Yeah. When was that? September? Date. September 12, tomorrow? Can you check the X dividend date for that? X dividend. Can you repeat the company name so that others can also help you? PPG, Dow, and Hershey. Can you check the X dividend date for that? I can do that, but if you're doing that, it will be more interesting for you. Or any dividend, if anyone else can give your own dividend search results. I want some company paying a dividend, when it is paying, when it is announced, when is the X dividend. Yeah.
The usual fund called.
Oh, I'm sorry, I didn't tell you that. Thanks for letting me know that when you say dividend, let us not talk about mutual funds at all, because mutual funds are meant for paying dividends. It's not, their profits are different. Okay, for example, REITs, every year whatever they earn, 90% they have to pay the income as dividends. I'm sorry for that, and thanks for that, rather. Yeah.
Because that Chevron they pay their dividends yesterday.
Which company? Chevron. Okay. Was that announcement, payment, or X date? The payment date was yesterday. Can you quickly tell me when was the X dividend, Chevron? Even anyone else, you can do that. Okay. Why I'm asking is, can you tell me the, yeah.
Just
August 19th is the X date? Yeah. Because there are three different dates, because dividends are usually, most of the companies pay dividends quarterly. Okay. So February, May, and August. Okay. So usually this follows, I think. So what I'm trying to tell you here is, whenever a company pays a dividend, for example, Costco is there around $1,000 or $965 or something. There I got 964. Costco is getting traded for 964. It has announced a dividend of $30 per share. What does that mean? It means $964 worth of Costco is taking away $30 worth from the value and giving it into cash, which means that will be reflected in the stock price. Once the dividend is paid, stock price of the Costco Costco's stock price will come down by $30. It is adjusted by $30, which is paid as dividend. That's what I'm trying to say. So when this happens, X dividend date. Every company gives X dividend date. So 12th of September is the X dividend date. If that is the case, whoever holds the stock of Costco till today, they get the dividend. From tomorrow onwards, you don't get the dividend. That's how it goes. Okay. Then, so that is ex dividend and cum dividend. So till 12th of September, it is cum dividend. Till today, it is cum dividend. Tomorrow onwards, it will be ex dividend. So the same things I just replicated. You can also get for your own company. This is the example of Microsoft, little old. Now quickly calculating returns. I think you might have done that. We have seen bond yields also. In the first class itself, we did some problems calculating yields. So you have dividend yields, capital gain yields, holding period yields, and expected returns. These are the broad forms. Let us see one by one quickly. I think this is what I was mentioning about. These are the companies you can see known for paying dividends consistently for the past 50 years. I think in terms of Universal Corporation has given close to 6% dividend yield. It has been paying dividends for 50 years consistently. Dover Corporation is paying for 70 years. They didn't miss dividend any quarter or any year. Then this is something interesting. This is what we call it as growth rates of dividend. Whether the dividends are growing or not, that is important. For the past 70 years, we are getting the same dividend. Doesn't make any sense. They have to grow. So what is the growth rate? You can see that here, Coca-Cola had a negative growth rate compared to last quarter. And highest was for 4% AbbVie Incorporation. I think this is about that. Then top dividend stocks to consider in 2025. I think Yahoo Finance has advised if you're interested in buying a stock which pays dividend, they have given some recommendations here. People's Bank Corp, First Interstate Bank System. I think you have many in this list. If you're interested, you can look into it. And there are top performing companies in terms of dividend also. They are termed as the leaders. You have the list here. Interesting. Then top dividend growth companies. I was just talking about the growth, and you have the growth here on the screen. Means when you say growth, it is all about the future. They're expected to grow in future. It's all about future. There is some analysis. If you're interested, go through that. Then how to calculate returns or yields? Only on, if you remember, we have discussed about bond yields. How much returns you get on bonds, we calculated. Now we're talking about stock. So what is the return if you invest in a share? What is the return you get? What do you get if you buy a stock? What is the return? What are the forms of returns you will get when you invest in a stock? capital gain and dividend. These are the two forms. If you buy a stock, there are two forms of getting dividend. One is dividend, other one is stock. These are the two forms of getting returns. Okay? You may get both. You may get one of these two. I think Microsoft for several years they didn't pay dividend. Capital gain is the only source of return. Just now we have seen so many companies paying dividends. So with that, you have dividends as well as capital gains. So when you look at dividend yields, it is important to know DP ratios. What is the proportion of dividends paid to earnings per share? Earnings per share is, if you remember, net profit. This is net profit divided by number of shares. Total dividend to be paid divided by number of shares will give you DPS. So DPS plus retained earnings per share is total earnings available for the firm. Then when you calculate dividend yield, this is what you have to do. Dividend received compared to the buying price or the purchase price. At what price did you buy this stock? You compare this and calculate the return. If it is only dividend. And if you have both capital gain and dividend, you combine these two. This is how you calculate dividend yield. Any question on this? To start with, today we'll be doing more calculations. This is the first step to start just now. Okay, we have an example here. And I just remind you, don't trust me. There could be errors on the screen. I want you all to calculate this and let me know whether I'm right or wrong. So the formula I gave you here is, if it is only dividend yield, you consider only this. If you have capital gains, you will be doing this also. Okay. So which one you will do? Is this only dividend or capital gains also in this problem? So there is only information related to dividends. It is both. Let us look into it. Okay, so what is the question asked? In your examination point of view, in your weekly quizzes or midterm or end-term examinations, follow a simple strategy. Make the problem part or problematic exercise very simple. Okay, what you have to do is first, you look at the question asked. Calculate its dividend yield. That is the first question. And there is one more question. Calculate holding period yield. There are two questions here. Let us see what are they. When you say dividend yield, what is the formula you have? This is the formula. If it is only dividend yield. Holding period yield means it is talking about for this 1 year, what happened? You just got the dividend or you also got capital gains. So what is the information given here? You can see dividends of 130, and before that they also paid this. So we have a how much in the year, how much dividend is paid by this company. This is the real data. Actually, I just found out I could get the data. What is the total dividend paid by J&J? Yeah. $5.08. $5.08. Quite simple, because it is sum of all the quarters. Usually most of the companies pay dividends quarterly. Okay. That is one. And is there any capital gain information given here for you? It says 177 last year. It is bought for 177 last year. And if you want to know the capital gain, what is that you should have? You should have two components. You should have current price, and you should have previous price. Two prices you should have. In the information, what do you have? This is current price or previous price? Previous. What is the current price? It is not given because in the class it may happen. In the exam they have to give. So my idea is, can you quickly find out the current market price of J&J and put it here? Maybe I got it as how much? 177.26. When I was preparing the slide for you, the current market price was $177.26. Okay. Okay. Assume it is 177.26 right now. Okay. Assume. And your purchase price is this. The difference between this and this is this. Okay. The sum, no, what's the difference between this and this? 177.26 minus 177.08. What's the difference? That difference plus 508 will give you $5.26. So why you actually got $5.08 as dividends, but you also had small capital gain here. Adding that to $5.26. So the dividend yield is, please calculate and tell me whether it is right or not. Yeah.
Where does the 177.26 come from?
Yeah, when I was doing the problem for you, I found it as 177.26 that time.
Oh, so like that.
Current market price, right? If you want to check, what was the price? Did you say?
178.5.
0.5? Yeah, that's good. Now, maybe a task for you. Ignore my current market price. As Walker was saying, 177 point.
178.5.
That is huge. Can you quickly give me the answer, please? Is there? Yeah, J&J should be there. Answer, please. I want all of you to practice, whether you use Excel or finance calculator or normal calculator. I want all of you to do it so that you will not have any problem in your exam. You will score maximum, you will get the best grades. When I did, the market price was 177.26 and my answer was 2.97%. That was the yield, holding period yield for this stock. But you guys say that, no. When you calculated, that was a different price. Now it is 178.50. So please tell me. Answer? Sorry?
3.67.
3.67. Okay. So why this difference? Because maybe I sold this stock last week at that price. Maybe you guys are holding this and selling today at this price. That's the difference. Got it? Fine. So that is historic return calculated, which we call it as dividend yield or holding period yield. Now, similarly, we have some return calculations for the future. For the future means based on future values, we try to calculate the return to make an investment decision. Historic calculation is to know how much I got. Should I hold this stock or not? But expected return, it is related to future. You're analyzing. Based on returns, you want to buy a stock. So how it goes is, same thing. The logic is the same. You'll calculate expected dividend. You calculate expected capital gains yield. Sum it up and you get the expected return. This is the formula. Okay. So let us do a small example on this. So again, look at the question asked. The question is, what is your expected holding period return? If you sell next year, not now. Okay. What is the information given? This is the purchase price. Maybe you bought it this month. You expect that in 2026 to be 42. And how much is the dividend you're expected to get? 2.42. So you got all the information, you're good to go. You have the dividend, you have the capital gain. So calculate dividend yield and capital gain yield, add it up, and you can get holding period return. Can you quickly tell me the answer? Is that the same? Okay, good. I'm doing good. Fine. So that is just returns. Okay. Remember, returns are different from valuation. Valuation is a different thing compared to returns. So returns give you some idea on how the stock is performing right now and in future. But valuation has a different flavor. It says firm has a value, equity has a value. I think in the beginning itself we differentiated those two. Then we also have valuation using price multiples. So when you talk about firm value, market value of the firm, which is sum of equity value, if you know, and debt value. That means the loan it has, the bonds it has issued, the notes it has issued, or whatever. Then book value, it is the value of assets on the balance sheet, on the books. Liquidation value, when the company is selling it, selling the assets of its own. Why does the company do that? When the company is bankrupt, they will be liquidating the assets. That time you talk about liquidation value. Then replacement value, there is a new regulation to meet environmental norms. You have to throw out your machinery and replace them with new machinery. That is replacement cost. Then there's something called topic skew, more with corporate finance. Then our discussion will be more on intrinsic value. Then equity value, it's a, you should know market value through the equity valuation. The book value is shown in the balance sheet, and the face value is 1 unit value of a share. I think I could put some old example. You have face value of 10 rupees per share. And price multiples, when the performance of your company, say for example, earnings per share is compared with market price, that you called as price multiple. We have more in detail. Okay. And some of the popular or celebrity investors, I think you know all of them if I'm not wrong. So Warren Buffett, he has his own style. Charles Munger, I already told you. Soros is more popular for his theory of reflexivity. He says that it is more of investors' belief system and the price which influence each other. That makes the price. Then Lynch, he is most famous for his Magellan Fund, which has given abnormal returns in his times. Now he's not with that. He has his own philanthropic investments. Then Carl, he's an activist investor who raises the questions. Then David is a contrarian investor and who is a hedge fund manager. His strategy is contrarian. Contrarian is all about going differently from the market. When everyone is buying, I do sell. When everyone is selling, I do buy. Contrarian investment strategies. There are some names for your thought. I'll share them with you. Okay, this is a kind of introductory level of equity valuation when you're ready to calculate equity returns and do some analysis. Any question from this? Now let us do more.